How about now? Good? I just had to click the button. All right, awesome. So you can hear me okay? Great. All right, perfect. Okay, we're gonna get started here. 2 seconds. Okay, but what I wanted to start out just by saying I'm really glad you guys decided to join the session today. I've been trading SPX credit spreads in various forms since 2013, and I've had a lot of challenges along the way. Trust me, a lot of challenges. And by challenges, I mean a lot of losses. So in any case, I feel now that the trade plan is solid. It's requiring subtle adjustments along the way, just normal things. There'll be a lot of people that'll tell you about this trade, and they'll tell you, oh, it's only a matter of time that you'll get wiped out, or you're just one trade away, and this thing is like picking up pennies in front of a steamroller. Well, without a trade plan, they're right, but isn't that true with most trades, especially if you don't have a plan? I can assure you that by adopting the years of work that I've invested into this trade, that your learning curve is going to be dramatically different than my own. Today, I'll be sharing all of my trades that I've placed from the beginning of this year through May. Okay, this will give you really practical knowledge, even if you're already experienced trading SPX credit spreads. In 2018, I decided to leave my IT career behind and focus on trading for me and to help others achieve the same success. I do believe that freely sharing what I know and helping others, that it'll come back to you in really good ways. It's okay. So let's get started, and this will be a very positive and rewarding session for you guys. All right? Okay. So let's put up the screen here. All right. And let's get started. All right. So what can you expect? I'm going to show you how I'm going to show you how you can make consistent returns monthly based on margin capital at risk, using high probability trades without taking large losses, and making those returns month over month. And when I say returns, I'm talking about 5 to 15% just on the monthly trade, with the amount of capital at risk that you put on. Okay. It doesn't happen every single month, but some months you'll have larger amounts, and some months you'll have less. Okay. And I've documented all of my performance over the past, I can't remember how many years. So that's something that's public for you guys to see. Okay. So what are you going to learn today? I'm going to select the right option spreads before the market opens, right? Where to enter and exit your trade, how to prevent large losses, have a general understanding for when not to trade, and how to trade consistently profitable, right? So those are the topics that we're gonna address in this session today, and hopefully, again, it's going to be very rewarding for you guys. I want to ask that you stay with us until the end. If you're on YouTube, hit the like button. Okay, it really helps out a lot. And I'm going to have a special bonus at the end, so stick with us, and you'll want to cover everything. Okay, you want to stick around and listen to everything. So I ask you to turn off all your distractions if you can, and just try focusing on what we're going to be talking about, and it's going to be good here. All right. So the first question I'm going to be asking is, why are you here? Okay. Now I set out like 3 different reasons why somebody would be here. Okay. And I think I've captured the right things, but maybe not. So the first one is you're interested in learning new strategies that will take your trading performance to the next level so that you can finally leave your 9-to-5 career behind. That's number 1. Number 2 is you've seen, heard about, read about others making money and trading, and you know that you can do it too, but you're just not seeing your account grow fast enough based on your goals, right? And 3, you've tried different trading strategies that you thought, okay, this is it, only to discover it's just not getting you to the place of consistent results. Okay. So with that, just let me know on the box there, on the chat there, which one is for you, or Kidding. All right, I hear you. 1, 2, or 3. 2 and 3. Yep. I was in that camp for many years. I'm telling you. 2 and 3. Number 1. Okay, great. It's always good to learn new strategies and to continue your education. Never let that down. Number 4. All right. What's number 4? I don't even know what that one is. All right. 1, 2, 3. Perfect. Okay. I'm glad you guys are awake out there. Okay. So let's move on here. So, okay, gotcha. All the above. Perfect. Okay. Hey, just want to let you know that I am a regular guy. I live in Puerto Rico, and the temperature today is 86 degrees. And it doesn't really get down further than that. It gets around high 70s, unless you're up in the mountains here in Puerto Rico. But here on near the beach, it's usually between 70 something and 90. Oh, beautiful climate. That's me on the left with my beautiful wife and my 5 kids in the middle. And that was me a long time ago doing my MBA with my parents there supporting me. All right, so let's start this session for real, right? With the right mindset. So I want you guys to think about, or imagine what it would feel like if most of your trades were winners month after month, and it would be confirmed by watching the size of your account grow at the same time. Okay, becoming the trader that no longer takes large losses, but consistently trades according to a proven trade plan that is profitable over time, allowing you to grow your account month over month. Now, there are different things, right? There's different things that go into that recipe to get you there, okay? And we're going to talk about that. And it may be some things that you're not even thinking about, okay? So again, having the right mindset, having a positive outlook on what you're doing is extremely important, and you want to have that going forward, all right? So it's part of the psychology of it, and it's just really important, okay? All right, so let's talk about the nuts and bolts here. SPX credit spread, what the heck is that, all right? Well, credit spread is a combination of 2 puts or 2 calls where the put or call that is sold is more expensive than the put or call that is bought. That's why it's a credit spread, because when you actually put on the trade, you're receiving a credit, right? And you can see your account tick up a little bit when you receive that credit. It actually happens. This is an example of a trade, right, that Thinkorswim uses. This is how they organize the trade to trade it, okay? Some brokers, obviously other brokers do it differently, but going through this, it gives you the whole caboodle here of what you need to understand. So first of all, the 10 means 10 contracts, right? Vertical means it's a spread. It could be a put, it could be a credit spread, or it could be a debit spread, all right? But it's a vertical because it's 2 of the same types of options on top of each other. The 100 doesn't stand for 100 companies, right? It's, because the SPX is actually 500 companies, but the 100 here stands for 100 shares per contract. That's what it means. Weeklies, these are options that expire typically Monday, Wednesday, and Friday. They also expire end of month and quarterly, okay? So they're called weeklies because I don't know why they call them weeklies. I guess you see them every week, all right? And then the strikes here, this is the actual expiration, 30 October 19. Yes, it's a long time ago, but it's just an example. And the 3010, 3005 is a 5-wide spread. It's called a 5-wide spread, and that on SPX, that's the closest you can have of a spread, okay? But you can go way out further than that, right? And this is a put spread, and it's 45 cents per contract. So 45 cents times 100 is the amount of credit that you receive per contract. So in this case, it would be $45, right? $45 per contract times that 10, it would be 450. So let's talk about, and again, you're selling the 3010 and selling and buying the 3005 to get a credit, right? Okay, and this trade is considered to be a high probability trade. And why is that a high probability trade? Well, you don't have to be exactly right in order to put on to actually profit on this trade. In fact, this trade can get challenged, and you can roll it. And I've rolled I've rolled a trade, and I think it's a record because I tracked it, right? This time around recently, 8 times. Okay, I rolled it 8 times, and I achieved profitability on that trade. Believe it or not, even after the commission, all that. I was able to get profitable in that trade. So that's why it's a high probability trade. If you manage it correctly, you'll end up positive in the end, right? So my record is about 95% profitable on these trades, okay? For a good period of time. So it's a great trade. It's a great trade. And this is an edge, right? So traders who have consistency always have edges, and basically are experience in their trade, okay? And sometimes, yes, I do pay to roll a trade. All right, so let's talk about the risk reward, because the risk reward on this trade really sucks. Okay, it's like the worst. Okay. And so that's why if you don't manage this trade, and it forces you to manage your trade, and it forces you to have a trade plan. So those are 2 components that, even though it's bad, the risk reward is bad, it forces you to do the right things in order to succeed, right? So again, let's talk about this 3010, 3005 put spread and the risk reward on it, okay? So because this is a 5-wide spread with 10 contracts, okay, 5 times 10, it's $5,000, or $5,000 is what you can actually lose on this trade minus the credit received, right? So that's the worst case scenario, and it has happened to me, all right? So you never want to be in this situation. And the only reason that I've succeeded is because I never quit, because I've lost a lot of money doing this. And but now I really don't. I'm actually making a lot of money using these trades, and so can you can, because I've seen now hundreds of people go from nothing to entering this strategy and making tons of money. Okay. And when I found it in 2013, I thought, oh my God, this is such a great, how can you go wrong with this thing? Well, I found out every single way that I could go wrong, but that allowed me to create an awesome trade plan. All right, so the max loss in this $5,000, right, which is also the margin requirement that it takes to put on this trade. And keep in mind that you also keep the credit, $450, but that's nothing compared to the loss, right? So you'd have close to a $5,500 or $4,500 loss with this trade if you don't manage it correctly. All right, so let's talk about some of the profitability factors. We'll go into those specifically, but theta is really the number one thing in this trade, and that's basically the rate of decay that happens. So let's look at call options on the S&P 500 and how they decay. So from 68 days to 33 days, the rate of decay is 34%. Okay. From 33 to 5 days, the rate of decay is 57%. See how it's going higher? And from 5 days to expiration, the rate of decay is 100%. So why do you think that my most profitable trade is 7 DTE? Because it decays the fastest out of all of these different types of credit spreads. Because that period of time, basically 5 to 7 days, the decay in that thing is extremely fast, okay? And you're able to get out of these trades almost all the time for a nice profit. Okay, and that's why I use it. All right, so now let's talk about profitability factor, and there are 3. right? There are 3 profitability factors. It's not only the rate of decay, it's also volatility. So implied volatility, and I tell everyone when you put on this trade, you want to put it on when volatility is relatively higher and you expect it to go down. Okay, so it's a little bit of predictive analysis here. Okay, when you're putting on this trade. So in a market that's going straight up, right? So the volatility is typically going down, but sometimes when the market goes up really aggressively high, volatility goes up as well, but it's seldom, you know. So typically when the market's going down, that's when volatility is typically going up, and that's when you really want to put on the trade. And because I put on mostly put spreads, which means I'm banking on the fact that the market is continually going up, and the fact is that that's the truth. Okay, so basically more than 60 or 70% of the time the market is going up. The rest of the time it's consolidating or going down, right? So it's either going up, sideways, or going down, and it's less than 20% of the time that it's going down. So I mostly put on put credit spreads, and that's really, really important because they're much easier to defend than the call spreads. All right, so volatility is one. When volatility is higher, the premiums are higher, and when you're getting into the trade, you're selling options, okay? And that's where you want the higher volatility. When you're closing out the trade, the premium reduces when volatility goes lower, and that therefore it helps you get out of the trade at a lower cost. So you're selling it at a higher cost, buying it back at a lower cost. I know it's a little bit counterintuitive, but that's the way that it works. Theta, we just talked about that, right? It's a big factor in 7DTE, and so you want to make sure that you're selling and not buying options for the most part. I do buy options as well, but I mostly always combine them with selling options at the same time. All right, and then market direction. So again, I tell you, if you want the market direction in your favor, you're gonna be trading bullishly most of the time, okay? And you're gonna be putting on put spreads most of the time. And if you look, and we're gonna look at this in a few minutes, and how close and how far the put spreads are to the call spreads in comparison with the same delta, you're gonna understand this better. Okay, all right. So let's talk about risk management guidelines and daily routines. I'm gonna go through these pretty quickly here. So risk management is very, very important with this trade. And number one is always trade with a plan and determine your max loss and risk reward before entering the trade. We talked about that and what that is. I'm very, very clear that you can get wiped, right, if you don't manage this trade correctly. And I don't want to paint a different picture. It's very, very serious. Trade no more than 20% credit margin on your trading capital, right? And so I combine this with different trades. So I trade 0DTE, 7DTE, and monthlies. And I use basically 20% of my capital on each of these trades. Little less with 0DTE and monthlies. I mostly put it into 7DTEs, but in combination, it's less than 60% of my trading capital. Don't allow more than a 2% loss. A lot of traders will say a 1% loss. So when you get a bigger account, you probably go back to 1%. It's more prudent, but 2% is good. So make sure that you don't have a loss of more than 2%. So $10,000 account, no more than $200. For highly trending market, position your trades to follow the trend. And which way is the trend mostly? Up. That was a trick question. All right. Never hold a short-term credit spread overnight. And when I say short-term, because I'm trading 7DTE, I will not, I think I've done it once or twice, that I'll let it go to 0DTE. So I'll almost always, 99% of the time, roll that trade before it gets to 0, okay? So typically 2 to 3 days out, beforehand, and then that's when I roll the trade, and that it's further away from the market. And we'll go through those details as we go through this. So please, again, stick around for that, because you're going to get a lot of information on how to do this. Size your trades, and this is really, really important. Size your trades to ensure that emotions are not part of the decision-making process. And how do you do that? By trading small and trading often. Trading often allows you to grow your practice, grow your experience in trading. Trading small allows you to think the right way. You're not gonna have fear and greed entering into your decision-making process. And whatever that is to you, that's how that's how I recommend that you trade, especially starting out. You wanna trade small. Okay. Okay, let's move on here. Pre-market routine. We're going to go in pre and post market routines, all right? And things that I watch for and do in the morning, aside from other million things that I do. Review areas of support and resistance. I always have that in front of me. I use fibs to do that. We'll look at that in slight detail in this session. Review the U.S. dollar, because when the dollar goes up, especially with multinational companies, such as the companies that are in the SPX, when the dollar goes up, it is more costly to sell their goods to overseas customers. Dollar goes down, it's cheaper. 10-year Treasury note. 10-year Treasury is really, really important in terms of interest rates, because when rates start going up, there's competition for dollars. And where does it come from? Easy money, right? So if you have interest rates that are high, you can just put your money away there, and it's very, very safe without hardly any risk at all. And when rates go down, the only place to go is the stock market. Okay, so rates moving higher will suck the blood out of the stock market, and that's why the Fed typically, when they want to keep things stable, they inflate asset prices, and asset prices are part of the stock market. Okay, so keep that in mind. Review trends using ES futures. So ES is the futures for the S&P 500. And if you have a trending futures market, typically it continues in that direction, and so you want to pay attention to that as well. VIX level. The VIX is the S&P 500 volatility index, and that's the one you would use to understand where the volatility is. So I keep attention to that greatly. And just to let you know, it's when you put on a trade, the best time to do it is the opening of the market, because that's where the highest implied volatility is, and you'll get better fills, for the amount of premium that you put on at that time. Alrighty, post-market routine. Determine if rules were broken and why. You should not break your rules, but if you do, you want to document that and figure out why you are doing it. Is it because you are undisciplined, or is it because you saw an opportunity that made it better? So opportunities may turn into complacency, and so you want to watch your emotions on that too. Determine if risks were within acceptable levels, especially for wins, and that's what I'm talking about. Determine if losses were within acceptable ranges, because you don't want to be trading with fear. So if you had a big loss, right, you're probably not going to follow your trade plan, because you don't want to go through that big loss again. And so greed and fear are two emotions that you want to stay away from, or have under control. Determine if tweaks or adjustments, or if adjustments to your trading plan is necessary. I go through those every so often. In fact, I have some that I need to make already that I haven't put in my trade plan, that I've discovered recently on my trading that's worked out really, really well. So that 95% return rate, I'm hoping to get it up to about 97%. And update your trade journals with your findings, especially if you're trading a new strategy. And that way, it is a learning experience, right? They say that you reading something and understanding it and writing it, it goes a long way to remembering. All right, so let's go through the strategy of the monthly. I want to tell you that this is the trade that basically allowed me to trade while I was in a very, very demanding career. And it was because you can almost set it and forget it. Okay, I'm not gonna say that you can, because you can't, right? You have to monitor it, but there's very, very little manipulation or management on these trades. Although when we go through the session here and talking about the actual trades, it's going to look like a ton of trades, but it's not. It's not a lot of trades that I put on for the monthly, and it's just a great career trade. And it's a great trade to start out because it allows you to understand the emotions involved in trading the strategy. And I can tell you one thing too, is that there are drawdowns in this strategy. Drawdowns where you see a lot of red on your screen. However, your trades are not threatened. Okay, they get threatened at certain thresholds that we have, but they're not threatened just because you see red. And a lot of people cannot handle that. And I can tell you that it takes a while to really just not even look at that and just focus on your trade plan. So, words to the wise. Entry and exit criterias. Let's talk about that. So, an entry for a monthly, I do 30 to 60 days and sometimes less than that. Okay. So when I have 23 to 30 days, like a lot of times what we get to, right? I may put on a trade when I have the right opportunity to do so, right? So if the market goes down a lot, we have good high volatility, then I'll put on a trade at 20 or 25 days away. Okay. All right. So volatility and I'm going to get to your questions at the end, by the way. Okay. I don't want to distract everything to answer them, but I will answer all your questions, at the end. And sorry I didn't make that clear at the beginning. All right. So 30 to 60 days, high volatility. And that's relatively high volatility. So if the VIX is at let's say 18, right, and it moves up to 20 or 21, well, that's an increase in volatility, and that's when you want to put on the trade, right? So you look at the range of volatility, and there's always a range for every market, including the VIX. And so lately, if the market goes way down, even longer term and shorter term volatility, it's got a range too, and then you have to keep attention to that. All right. Bear spreads. Bear spreads means call spreads, right, that you're putting on. Should be entered cautiously with a hedge using a debit spread of 5 points above the long position. I used to do that a lot more. I don't do that much anymore, just because I don't put on a lot of call spreads, to be honest with you. However, it's a good idea to put on a debit spread above the positions that you have on, that you've sold as a hedge, and that way it's less costly for you to roll the call spread. And again, I just want to mention that call spreads are more challenging to manage than they are the put spreads. Use a 10 to 12 delta for bull spreads and 5 to 6 for bear spreads. And the reason for that is because bull spreads are much further away from the market with the same delta, and I mentioned that at the beginning, than they are on call spreads. So you'll even get less, even if you go down to a 5 or 6 delta, you'll still be closer to the market than you are for bull spreads at 12 delta. Okay. For 5 wide, a premium of 30 to 45. If you're using 10 wide, I go to 70 to 90 at times on those. Okay. All right. Take profit, 50 to 80% of credit received, right, or greater if the market is favorable, if it's going in your direction. And so when I put this on, when I put on a trade, I immediately set a closing order to 10 cents, just automatic. I just put it on. And the reason that I put it on there is because a lot of times I'll have a lot of positions on, and I forget which ones are there. And so I use those closing orders to track the positions and keep them in front of me at all times, right? So that's really, really important. So whatever way you use it, make sure that you're tracking what you're doing, so that you don't make mistakes. There's a lot of mistakes in trading. Sometimes I put on a debit spread instead of a credit spread. Sometimes I may be using a different broker. And remind me, by the way, I wanted to share with you about a broker, a story, not a story, actually. Anyway, I'll share that with you with another brokerage that we're doing. That's another bonus for you guys. Okay, so either way, an acceptable profit limit is 50 to 80%, and a lot of times I go to 90 on these, right? For positions that have been rolled or adjusted, profit target should be less than that. It should be 20 to 50% of credit, because you want to get out of threatened positions as fast as possible. Because typically when you're in a threatened position, it continues to be threatened, just like that trade that I shared with you that took me 9 rolls. Actually, 3 of the rolls were to gain credit, not to manage the threatened trade. It's also acceptable to trade, allowing your positions to expire worthless, but I still would not recommend that, even probably at 10%. One thing that happened to me, and when I trade monthlies, I trade AM expirations, right? And I trade AM expirations because there's liquidity on the SPX. I've traded RUT, I've traded NDX, and when the market, and I've traded SPX weeklies as well, and when the market is very, very, very far away from your positions, you may not be able to get out of your positions, even SPX weekly trades, okay? And so they become illiquid, and you do not want to be stuck in a position that you can't get out of, right? Having a lot of margin on there, okay? Okay. So, but in any case, I don't let them expire. I never let them expire. I could say that. All right. So initiate a roll on the monthly 2.5% to 1.5% if it's threatened on the short strike. Okay. And you can use numerical values as well on that. Typically 50 points away will get you, will put you in a good position to be able to roll the trade without having a lot of expense and having to push it out way, way, way far. All right. Stop loss, I don't use stop losses for these trades, other than, if I see just a call spread that's just annoying, and in fact I rolled up one today, right? And I don't feel like managing that trade. I'll just take a loss on it, as long as it's not a huge loss, and move on. Okay, so I've done that before. All right, so let me give you an example of distance here, right? And again, the example is a long time ago, but it still holds true. So you can see here with the same delta, and these are 5 wide positions, there's 272 compared to 173 distance from the market. So that's 100 points, and that's a low level in the market, right? With 2,400 or 2,600, whatever. That's a really low area in the market. That's a big percentage difference between the call spreads and the put spreads. And that's why I just don't put them on. I don't put on the call spreads that often. I do at times when the market's really, really pushing up and going to extreme levels. I may, because I wait for volatility to increase, I may put on call spreads, and I have recently done that, and sure enough, you have to roll them. Okay, so let's go through this. So this is an actual trade that I did a long time ago, and it's just a good example for what happens. And and if you're doing this early, okay. So the trade got threatened. You can see here that the premium went down to 5 cents, and on the non-threatened side, and 90 cents on the threatened side. All right. So what did I do? I adjusted that trade, and here's the adjustment process. And so the first thing I do is I close out the non-threatened trade for a profit, right? I close that out, and what does that do? It'll free me up. It'll free up the margin if I have to roll out to another expiration. Okay, it frees up the margin to do that. So I close that trade out. The next thing I do is I roll the threatened trade. In this case, it was the I rolled out the December 24.15, 24.10 down to 23.40, 23.35. Okay, and it cost me Zippo. It cost me nothing to roll that trade when I did that. So I rolled it for 0. It's a debit 0 or credit 0, whatever you want to call it. And here's a specific trade that it's a vertical roll, and this is how TOS does it. Okay, moving it from December, right, 21 December to 18 January, and I rolled it from 24.15, 24.10 to 23.40, 23.35, near almost 100 points away. Okay, and again, I did it for $0. Now, when I put on the call spread, I put on 50 cents, and so I actually gained 45 cents on this trade. So you guys did the math, right? Okay, so remember, I closed the first position by 5 cents, and then I rolled it for 0, and then I put on a call spread, and I got a credit of 50 cents minus the 5 cents that I paid for, credit of 45 cents more, right? So I ended up closing this trade for a nice profit, and in addition to the premium collected at the beginning, right, which was I think was 30 cents each. I collected premium at 115. I think I closed it out for like 20 cents or 15 cents or something like that, and I got a nice gain. So this is a very, very, very typical trade that we do. All right, and here's how I ended up basically. So still closer to the put side, or than the call side, but after the market goes down quite a bit, right, it will typically start going up and more aggressively higher once it's cleared out and washed out all the sellers. All right, so now we're going to go through the trades that I did this year at the beginning, started at the beginning. So let's walk through this here, okay? So that thing off. Thank you. All right, so now on January 12th, I sold to open a 5 vertical, right? 34.25, 34.15. Now we're doing it in 10 wides, okay? So I collected 85 cents. And again, this is going to seem like it's going to go really fast, okay? But it's, so look at the dates. So from the 12th through the 20th, right? That's how many days? 8 days. So 8 days later, right? I actually bought to close that at 55 cents. It just had an opportunity. The market went up quite a bit in a very short period of time. So I collected 150 bucks on it. Okay. Then I sold to open call spreads, which I don't regularly do. But you can see here that I put them on at 55 cents compared to the 85 cents. So the delta was much lower. And I did it because the market had gone up quite a bit, and I was able to put on that trade, right? Then I sold to open when the market went down. I sold to open 34.25, 34.15 at 70 cents, right? So I used a little bit lower delta on this one. Then I closed the trade because it went. You can see where it went up quite a bit here, right? It just shot up after this. And then I closed the trade for 10 cents, collecting 60-cent credit here on that. Okay. Then I sold to open a call spread, and collected 65 cents, and then sold to open a put spread for 65 cents. And so the market was pretty volatile at this time, and I was using a lower delta just because of that volatility. So February 11th, I closed the call spread at 10 cents. Remember that one that I put on on January 21st. Now remember, this seems like it's going fast, but look at the dates, right? It's just a really slow trade, and you have so much time to think and manage this trade. It's a beautiful trade. And then I basically bought to close the call spreads at 35 cents. That was about a 50, probably less than 50%. Again, I'm managing a more risky position, so I close the trade earlier than I would with the put spreads, right? So now I put on another call spread at 55, and then close that trade soon after. Let me see, this one closed the call spread for 15 cents, right? So I was able to close it even after it had gone higher, right? Okay, all right. So now you're getting the gist here of this thing. So that covers these set of slides, or this set of trades, right? So in that time period, I was trading 5 contracts and I made $1,000 already. Let's move on here. Now we're starting with 1,025. So I sold to open a call spread at 45 cents. And I had, okay, so a condor. A condor is, this is what Thinkorswim uses, all right? Thinkorswim uses to roll a position within the same expiration. So I actually rolled this trade up, okay, and collected an additional 40 cents on this trade. And I do this often, right, with these trades. It's a condor, but it's not a real condor in the sense that you're putting on a new trade. I'm closing one trade and I'm putting on the other, right? So basically I closed the 35.50, sorry about that, 35.50, 35.40, and I opened a 37.25, 37.15, okay? And I collected 40 cents on it, okay? All right. Then I bought to close the call positions that I had on for 10 cents that I put on for 40 cents, 45 cents, okay? Okay, then I sold to open a 6 contracts. Okay, now you can see here that I'm starting to increase the number of contracts, and that's based on my capital growing in this account, right? So now I'm up to 9 in this account. All right, so I put on that trade, and then I again rolled it up again. So I used the condor to actually roll it up within the same expiration, right? Then on the same day, on April 7th, I sold to open 37.25, 37.15 for 60, and I bought to close the trade that I put on before at 10 cents, another put spread. Okay. So that gives us $1,700 total, running total here. Oh, and now you're going to see, I gave them everything. Okay, so there we went from, let me see here. Okay, so now you're going to, the numbers I didn't put in there right, but anyway, you get the gist. All right, so I sold to open a call spread for 45 cents and sold to open a put spread for 55 cents and then was able to close the put spread for 30 and sold to open another put spread for 45. Here again, I moved up the position within the same expiration, collected an additional 20 cents, and then I was able to close the call spread for 5 cents, right? Then I bought to close the put spread for 5 cents, and I think that covers it. Okay, there, okay. That covers it there. And now we're moving on here. And so in May, I put on, again, I went up from 5 to 6, now to 7, right? So I put on a put spread for 65 cents, and then sold to open a call spread for 45 cents, and then closed that put spread for 30 cents, and sold to open another call spread for 60 cents, and sold to open a put spread for 65 cents, and that covers that. Okay. All right. So that covers that through May, right? And you can see the increases there on the credits. All right. Okay. So let's go in through a little bit of technical analysis here, just quick, because I want to show you the main thing I use is Fibonacci retracements. And so this graph, okay, this retracement here allows me to start at the beginning here, and this is a drawing, okay, and go right up to the top of this. And so when the market starts going down, I have support levels, right, that I can watch as the market goes down. Now, when you look at this, you can see here how in the past, right, these fibs line up to different support levels, right? Okay, so we moved it, you know, that going from the bottom to the top, okay? And then I wanted to share with you, this was a huge move in April, okay? This move here. And so here are the weeks actually. And it was just, you know, put spread after put spread after put spread. And I know that in April I made 3K just in that 1 month with 70 TE, right? So, but in any case, you can see here where these levels are, and I'm gonna highlight those here, okay? And that's how Fibonacci works, allowing you to see your support and resistance levels, which is I basically use that exclusively, except for a couple of other indicators. But most indicators are based on, you know, on support and resistance. And so why not use the best, which is Fibonacci, okay? So you want to get adept in using that that tool, right? And so, so a little bit more here on tech analysis. Okay. So here's another representation in a shorter time frame chart where I use levels here, Fibonacci levels, and you can see that they really go and stop and start in those different sections, right? One thing I wanted to share with you too, just a little bit here, is divergence. And so you can see here that at the MACD or the RSI, if you use it, basically it tells you that the momentum is slowing, and even though this is going up, and it's called convergence. All right. So that's it on the indicator side or tech side that I use. It's very simple with credit spreads. All right. So let's move on here. And so I wanted to share with you how best to utilize what you've learned here, okay? So the question is, if you'd like to follow my trades and learn using the 4 strategies, it's not 4 strategies, I really outlined 1 strategy here, okay? And how to be a consistently profitable trader. This is it, okay? And I'm going to share with you a program that I put together that utilizes all of the things that I just talked about here today to allow you to have an edge and to earn what you learn. All right. And so we talked about why you're here, interested in learning new strategies. Maybe you're not seeing your account grow month after month. You haven't found the right strategy with consistent results, right? Well, I'm telling you, this is it. You can actually break the barriers and become a consistent trader, all right? With again, with all the experience and the trade plan that I've put together, if you can utilize that, you'll be a consistently profitable trader going forward. All right. So what does it take? Learning, training, instruction, practice that leads to success. Okay. And the question is, are you going to keep doing what you're doing and hope that one day, something will stick, or are you going to finally take the steps that will get you to the place that you want to be and that works? And when I started my journey in 2013, I said, I'm tired of taking losses, and I felt like I found a strategy that could really work with me, at that time. And I said, and I'm going to give it my all to make it work. Well, years later, right? It took me a lot of years later and big losses. I was able to get to that point, right? And again, what I told you from the beginning, all the learning curve, that I went through is going to be minimal for you, in terms of understanding the tactics of putting on these trades, and that's really it. But knowing how to utilize it and do it the right way is something that you're going to be able to do. Okay, so it's not only the learning, training, instruction, but it also takes discipline, it takes commitment, it takes having an edge or multiple edges, and a no quit attitude, right? So if I would have stopped with the losses that I had, I would have never been here at this point. Okay, I would have continued my IT career and retired and been bored. But now, I'm doing what I dreamed of doing. Okay, and you can be successful too, right? So here's the program. In 2018, I started out by saying, okay, I'm gonna create a course and work with these people and coach them, and I did that. I did a lot of that, all right? But then I thought, okay, why not take my own trading, all right? And this is what I did. I took my own trading, I integrated it with a program I found with Telegram, okay? And basically my trades are the trade alerts that you get. And so the trade alerts are my trades, and I'm in it, okay? I'm in it right with you, all right? These are instant trade notifications sent directly to a phone or computer. It works on every platform, all right? And these are high probability options and futures trades that we do too. I mean, it's not only the monthly, we have a ton of other trades that we do. And we have full-time traders in there as well that will teach you, okay? Teach you for the subscription price that we have. I do have a course, and I'm gonna share that with you, and it's a great starting point. But we have real coaches in there that actually teach you how to do this, including myself. All right. So whether you're getting started or already successful, the trade alerts will help you trade at your highest level for sure. It's designed to transform your trading from uncertain to predictable. And let me tell you something about this, right? I learned really, really quickly because I was doing a lot of other trades, okay? And I was still not seeing my account grow, right? Even trading these trades. And I realized that I was trading these stock trades and these other options trades that I was losing money, but these were making money, but the losses were offsetting the gains that I had. So I said, forget it. I'm just going to completely focus on that. I'm not going to trade anything else, and that's where I saw the huge gains that were coming in, right? Okay, so in this group, and we've perfected it over basically 3 years, right? We have different chat groups to ensure that there's no clutter, that you get a pure trade alert that has no ambiguity, and the trade alert comes directly from my account. So I put it in, and a few seconds later it shows up, and then I can answer any questions that people have. And so we have chat groups that are two-way communication and chat groups that are one-way communication. The one-way communication is uncluttered and only ask questions if you know about that specific trade that you want to know about, so we can answer those questions immediately, so there's no mistakes, no ambiguity here. All right, these are the channels, right? And you can see here that these come in and there's no communication other than one-way communication, right? That it comes in. All right, and so that's really how it works. And I just want to communicate some success stories here, right? Marianne is still with us, right? And just great testimony that she gave me about being a mentor in the program over a year now, and I think it's almost 2 years now that she's been with us. Favorite trade strategy, 70 TE monthlies, and I'm able to finally make money trading. Okay, Bruce has been with us for a long time. And you can see here he tracks the win rate on this. It's 94%, and it's documented gains, 5 figures, 31% gain in my option trading account in 5 months, right? And so and again, he talks about risk management and having a trade plan, and all of this is included for you guys as well. Glenn has been with us for about 7-8 months now. He started about 7 months. This is, I put this up, several months ago. But he actually had profits in 4 months of 22K, right? Now he trades a little more aggressively. He trades bigger contracts than I do. But he's able to really leverage it and work this thing out, and doing really, really well. Just to let you know, he's actually a pastor in California, and really loves the service, and he's doing great. Okay, so we're going to talk about the price in a minute here, but I got a guarantee too. Okay, and just wait for the bonus here, because it's coming. Subscribe for 1 month and lose money by following my trades, and I will refund your subscription by 125%. Well, guess what? I have never ever had to pay back someone on this guarantee in the 3 years that I've been running this program, right? So that's my guarantee to you. So my guarantee is that you're going to make money in the first month, and I can tell you it's going to pay for your subscription too. So the price of this is normally $59.99 and $129, and in January we're going to be raising the price, okay, from the discounted price. So this is the last time that you're going to see these prices, and so I just want to let you know that, and then we're never going to raise the prices on the people that are in the group right now. So we're almost at 400 members and growing. And they're all making money, and we wouldn't have that many members if they weren't making money. I can guarantee you that. And so let's see here. Let me put up the offer. If I remember how to do this. Go. Okay. So that's how you get in. And I'm gonna, this is gonna be in place. We say, about 3 hours, and then we're going to increase the prices to the regular rate. Now, we had a wait list group of people that could get in during the last week at these prices, but during this webinar we're gonna open it up to you guys to join for the discounted rate. Okay. So in addition to that, I mentioned that I do have a course. It's $120. It's normally $149. It's $129, and you can see here that we cover a lot of topics, including putting a trade plan together, how to manage and master your emotions. We talk about the option characteristics, and then go through the specific strategies that I use for 0 DTE, 7 DTE, and monthly. All right. Okay, so the question is this for you? You want to learn a step-by-step process to gain income in a market that goes up and down? You want to finally break the series of losses and account drains? You want to earn consistent income that sets you apart from other traders? This is it. A lot of people come in, they learn because we provide a ton of education, and in addition to the real-time education that we put on, we also have a content section as well that we're feeding information in there too, so you'll have access to that as well, right? So it's not good enough. It wasn't never good enough for me to say, okay, here's a trade signal, you're going to make money, move on. We really wanted to make it a learning process so that this is something that you can take with you and you'll make money for the rest of your life. Okay. All right. So what do you have access to? 20%, $20 off of each of the subscription plans that we have. You can cancel at any time. In fact, you can go in there, in the same place that you subscribe, you can actually cancel it at the same time. And a lot of people do that just to make sure they're not reoccurring. Okay. But a lot of them hang around. Most of them actually stay with us. But I'm just telling you that if you're scared about subscriptions and getting scammed, you're not going to get scammed here. And a lot of people actually don't know how to cancel, and they reach out to me, and then I cancel it for them. All right. So I don't hold anybody hostage here, and this is just, it's nothing that you guys, have to worry about. Okay. Professional traders, and again, there's actually 4 professional full-time traders in there that are trading with the group. Okay. So we do have a professional trade chat and subscriber chat groups. So we have subscribers that trade for a living, and they share their trades. So you're getting on top of these trades that I'm talking about, you're getting additional trades. And honestly, sometimes it's overwhelming when you first come in. So I just want to share with you that and we have an orientation we have an orientation that you can go through to make sure that you're not going to be overwhelmed, and how to set your trade alerts and all this, right? And you can always ask me questions as well, right? Again, I mentioned the training and education that we have, automated signals that come in, the trade entry, fill price, target, and guarantee that you will make money, all right? It's just a winning combination. In fact, this morning, we have a whole new group of people, and we actually had to adjust the trade, and it just went really, really smooth. Okay, really smooth, because I walked them through to the orientation session where I go over that type of trading. Right? Again, you have the guarantee, and great testimonials from people that have been with us for a long, long time. All right. So with that. Questions that you guys have. Let me go up here. Good. Okay. Still chasing end of year performance and banks, institution squeezes. Okay. Correction coming. Right. Please elaborate on AM monthlies. Okay. AM expirations. So let's talk a little bit about that. So AM expirations are the original options that institutions used, right, to hedge their positions. They used options, and they still do. And so those are European type of options. And they actually stop trading on the 3rd Thursday of every month at 4 p.m. So after 4 p.m., what happens is futures take over, and you cannot adjust your position after that. All right. And that's why I don't let them expire, because they're AM expirations, but I use them because of liquidity. All right. So I just close them before they expire. Okay. Okay. SPX is often weak, August to October. Yes. I did use bear calls on those times as well. Internet issues. Okay. See here. What time frame? What is the time frame in this slide? Oh, the time frames. Okay, the slide I use daily and a 5-minute chart on those time frames. Minimum account size, I would recommend $3,000 minimum for this type of trading. And thanks, Kenneth. I appreciate that. It took me a lot of years to put that trade plan together. Okay. How can you show how you trade? Okay, we actually in this program, we actually have live trade rooms. They're actual webinars, the one that I'm using right now. And Ike is a very, very proficient Elliott wave trader. And we have Ted, who's a scalper on futures, has another room as well, and basically they're there and talking through the trades live. Okay, they're just there live. So that's how we use those trades for futures, and they're making a lot of money in futures. I trade futures too. I just do swing trades, right? And I'm doing pretty well. How do you have video education? Video, they're live daily. They're actual live trading videos that we do daily. Okay, so you can join at any time, and a lot of them are recorded. If you do subscription and you're to your room, we learn everything in the course. Should we still buy the course? It's up to you, Jay. You know, if you're, you know, everybody learns differently. Some people like to read and go through things methodically. Have a lot of people that buy the course, but you're going to get hands-on in the subscription service as well. Okay. Any other questions here? Fibs, what time frame? Yeah, the time frames that I showed were daily time frames primarily, and then I showed one with the fibs that were 5 minute, I believe. Okay. Right. Any other questions? All right, guys. This is the way, I am telling you, this is the way that you're going to get you're going to be able to get real live training, you know, from people who have been doing this and trade for a living. It goes from my account into trade, you know, the trade alerts, and you're alerted. And you know, and any questions that come in, we walk you through that as well. Look, you know, just try it for a month. You know, and the environment is amazing. It's really amazing. The culture that we've put together, people helping people. And I can tell you that success breeds success. Okay, and so, you know, it's just a great way to really learn this. And a lot, you know, actually a lot of people stay with us for you know 4 months, and then they leave. They've learned what they wanted to learn, and they go on their own and trade. You know, some people like the camaraderie and having you know, because trading can be a lonely business, you know, and they just like being together. And you know, after a while, the subscription fee is nothing because they're making a ton of money in there. Okay, and how do you think that, you know, institutional traders make a ton of money? They trade in, you know, in groups, and they have plans, and they, you know, they execute, you know, with trades that work for them. This is basically the same thing on the retail side. You know, you have you know, professional traders now. You know, not just me, but you know, but I learned from these guys as well, you know, in this group, and we're learning new trades and putting them on. So it's a great way to really master it. And again, I wanted to share with you regarding the broker. Okay, with E-Trade, I formed an agreement with them that for all of our traders, the commissions are going to be 35 cents, okay, per trade, per contract. And not only that, they've guaranteed me that if we have enough increase in the number of people that move to E-Trade, now I have an E-Trade account and I trade, you know, some of my trades is in there as well. But they guaranteed me that they will move it down to 25% or 25 cents in a few months as well. So right now I'm paying 50 with Thinkorswim. I pay now 35 cents with, you know, and it makes a difference. It makes a difference, especially if you're using a lot of contracts. I will be continually making agreements with other brokers. Thinkorswim is tough, you know, but I'm going to Tastytrade, Tastyworks as well, and try to form an agreement with them as well. And so we're getting now traction and being able to use lower commissions is great, you know, and we're going to have a lot more different types of bonuses like that as we get larger and larger. Okay. All right. So this is what I had for today. Hopefully this was of value to you. And again, if you're on YouTube, like that button and You can ask me any questions that you want. I'm always available, always accessible, especially in the trade room where you can reach me. All right. All right, guys. Thanks a lot, and have a great day. And hopefully, I'll see you in the Trade Alert room in there. All right, guys. Thanks a lot.